Hello everyone, this is Samie and I welcome you all to eAcademe from the platform of CA Educationist. Marginal and absorption costing are two of the most popular costing principles under which the profit statements are prepared. These costing principles primarily differ in their way of valuing the inventory levels. Before we discuss key differences between them in detail, let us understand three important concepts. Product costs. These are the costs that go into the cost units or products and are expensed out in the period in which those units are sold. These are the costs that are incurred in manufacturing of products either directly as material and labor costs or indirectly as production overheads. Period costs. These are the costs that do not go into cost units and instead are expensed out in the period to which they relate. Full production costs. These costs refer to the total costs incurred in manufacturing of the products. These include both variable and fixed production costs, which can further be classified into direct materials, direct labor, and production overhead costs. In simple terms, these costs can be thought of as the costs incurred in the factory area of an organization. Non-production costs. All the costs other than the production of units in an organization are termed as non-production costs. For example, selling and distribution expenses, administration expenses, finance costs, and other miscellaneous costs. In simple terms, these are the costs that are incurred other than the factory area of an organization. Let us now understand the two costing principles by differentiating between them. Absorption costing treats full production costs as product costs. In other words, inventory units are valued at their full production costs, and these costs are expensed out in the period in which the units are sold. On the other hand, marginal costing treats only variable production costs as product costs. In other words, inventory units are valued only at their variable production costs. You must note that variable production costs include direct materials, direct labor, and variable production overhead costs. The second difference is that absorption costing treats only non-production costs as period costs, whereas marginal costing treats both non-production costs and fixed production costs as period costs. The third difference is that absorption costing calculates gross profit before the computation of net profit or loss. On the other hand, marginal costing calculates contribution before the computation of net profit or loss. Contribution is that portion of profit that is entirely variable in nature. In other words, contribution is directly proportional to the volume. In absorption costing, all production costs, may those be variable or fixed, are subtracted before computation of gross profit. And all non-production costs, may those be variable or fixed, are subtracted after gross profit. On the other hand, in marginal costing, all variable costs, may those be production or non-production, are subtracted before computation of contribution. And all fixed costs, may those be production or non-production, are subtracted after computation of contribution. In other words, absorption costing classifies total costs with respect to nature, which are production costs and non-production costs. On the other hand, marginal costing classifies total costs with respect to behavior, which are variable costs and fixed costs. The next difference is that the scope of absorption costing is external, whereas the scope of marginal costing is internal, which means absorption costing is used to prepare profit statement for financial and tax reporting purpose. On the other hand, marginal costing is used to prepare profit statement for the management to perform internal analysis and take different business decisions. The last important difference is that the concept of fixed overhead absorption prevails in absorption costing system, under which fixed overheads are constantly absorbed into cost units as they are produced based on predetermined or estimated overhead absorption rate. Once the period lapses, actual fixed overheads are compared with absorbed fixed overheads. and the differential is booked as underabsorbed or overabsorbed fixed overheads. On the other hand, there is no need for under or overabsorption of fixed production overheads in marginal costing because fixed overheads are treated as period costs instead of absorbing them into cost units. Thank you for watching the video. For more videos, keep watching the series of eAcademe from the platform of CA Educationist by Muhammad Samie. For any queries, you may WhatsApp or email at the given contact details.